Will this global market rout, which was triggered by sharp declines on Wall Street last evening, haunt U.S. equities today as well? The U.S. stock index futures, which were earlier indicating a positive open, are in the red now. The Dow Jones future is down, indicating that U.S. equities might open lower. But with a few more hours to go for Wall Street opening, the situation could change at some point. Let's also take a look at how the dollar is faring versus a basket of major currencies. The greenback is weaker versus the euro and the pound, but is stronger versus the Swiss franc. The dollar index is below the 90 mark at 89.4. Meanwhile, U.S. government debt prices have risen sharply as investors flee to safe havens. So the yield on the benchmark 10-year bond is down 2.72%, right now over 3% in the red. In the commodity space, it's a mixed picture. Crude oil prices continue to ease, with the Brent down around 1%, trading around the $67 a barrel mark, while the NYMEX is also in the red right now at 0.7% in the red. On the other hand, gold is inching higher. The precious metal is in the green on the back of safe haven trading. So what do experts make of this global sell-off triggered by concerns regarding higher inflation in the U.S. and 3 rate hikes by the U.S. Fed this year? We spoke to a bunch of prominent voices from the equity space. Here are how they look at the current situation and its likely impact on Dalal Street.
We don't have any of these big festering problems that are suddenly manifesting themselves. I think that what happens is what has triggered corrections in the past historically has been a fear about growth, some geopolitical issue, or a fear about inflation. And I think that what we got here is just a little bit of a fear of inflation creeping into the markets, and you get a little bit of a correction. Now, what will distinguish it from, say, a bear market, so if you have a 10% decline, you get a correction, bear market 20% decline, is whether or not those fears become reality. And I don't think that the fear of inflation is going to become a reality that's going to signal that this bear market is over.
The assumption that this is a good old-fashioned correction and has not a lot farther to go in terms of price, I would not make any changes at all. We do need, as everybody's mentioned, to keep a careful eye on inflation. The wage number was troublesome, and that calls into question how many rate increases the Fed might go. Now, we also know that monthly number is a very volatile series, so we'll see how that shakes out. But I would not change my view on the Fed going 3 times this year.
We like places like Brazil, we like Russia, we like Korea. As you know from a previous interview I did with you a few days ago, we're a bit more cautious on India now, but I think we just have to see where the bottom is in the U.S., and frankly, it may not be that far away.
The pace of the decline, is astounding, but we've not yet eaten up the returns that we've seen in 2017. Even in India, I argue that yes, you will see good quarters in December and in March. A lot of it is frankly base effect, but I expect the earnings growth momentum in FY19 to actually be better than FY18.
And it's not just the equity markets. Cryptocurrencies have also been taking it on the chin all week now. The Bitcoin slid below the $6,000 briefly today. It is currently below $6,300. Other virtual coins like the Ripple, Ether and Litecoin also slipped around 11%. The fresh falls come on the back of reports that the Commodities Futures Trading Commission and Securities and Exchange Commission in the U.S. will discuss regulatory oversight for the asset class. Onto a CNBC TV18 exclusive. Despite the National Stock Exchange's best efforts to delay the launch, trading on 50 Indian single stock futures started on the Singapore Stock Exchange yesterday. The Singapore Exchange currently offers trading in Nifty index contracts, which are very popular among overseas investors. The fear being that the same will happen with stock futures now. Volumes will shift from India to Singapore. Vikram Limai, the MD and CEO of NSE, spoke with CNBC TV18 and told us that we should expect authorities in India to respond to the move by Singapore Stock Exchange. The move, when announced, will be aimed at protecting its turf.
They've decided to launch single stock futures, and they've done it yesterday. I've actually said this in public before as well, that there is a concern surrounding liquidity moving offshore, and that is a legitimate concern. It is obviously not good for Indian markets if liquidity moves offshore, and from that perspective, therefore, there will be some reaction that will come from from the Indian regulator and exchanges surrounding the development of single stock futures being launched in Singapore. I cannot get into more details surrounding what that could be, but I have said this in public, and I have said...
You're saying there will be a response from regulators here in response to the exchange they're launching.
Look, there is
contracts.
like I said, there is a concern surrounding liquidity moving offshore. Now, if there is a concern surrounding liquidity moving offshore, something needs to be done about it. And in that context, there are obviously discussions ongoing. We will see what ends up happening as a consequence of those discussions. But I cannot elaborate and get into details of what options are being considered or what could happen or what the regulator may or may not
But legally, I mean, in that sense, they're in the clear, right? I mean, they can launch. Nothing prohibits them from actually starting these contracts. I mean, that's why they've gone ahead.
Obviously, in the current construct, what they've done is cannot be illegal. Otherwise, they wouldn't have done it. Yeah.
On that note, it is time for us to take a short break. But coming up on Reporter's Diary, a CNBC TV18 poll suggests that the RBI's Monetary Policy Committee will hold rates tomorrow. More details on the poll when we return. Stay tuned. Welcome back. You're still with us on Reporter's Diary. The Reserve Bank of India will be presenting its policy review tomorrow. A CNBC TV18 poll suggests that the RBI's Monetary Policy Committee will hold rates this time as well. However, a majority of them believe that a 25 basis point hike is likely in this calendar year. Ritu Singh has all the details. Ritu?
Well, the bond markets and as well as the banks have already signaled the end of the rate cut cycle, and that is what our poll predicts. The Monetary Policy Committee will also do on the 7th of February. 100% said they do not expect any action on the repo rate front. In fact, we asked them what action they see for the entire calendar year, and 40% believe that the rates will be left unchanged at 6% throughout 2018, but 60% believe that with the risks to inflation rising, there is a chance of a 25 basis point hike in the second half of this year. We also asked them the statutory liquidity ratio, if any change is expected, but none of the respondents expect any change on SLR. On the macro, however, the street was more divided as far as the FY18 GVA forecast of 6.7% is concerned. 50% of the respondents believe that it will be left unchanged, but the other half believed it could be lower to match the CSO estimates. On inflation as well, this 4.3 to 4.7% forecast for the second half of this year, a majority believe will be raised given the threat to inflation from rising crude oil prices, as well as the government's promise to increase the minimum support price, can both impact inflation in the second half of this year. For FY19, 90% believe the range will be left unchanged for now, but there could be revision later when more data emerges. We also asked them what the stance of the policy will be. 100% said they expect RBI to maintain the neutral stance. And lastly, we asked them the statement itself, will it be more hawkish or dovish to the previous policy? The majority believes that given the risks to inflation, it will definitely be more hawkish than what we saw in the previous policy.
All right, Ritu, thank you so much for bringing us those details. It's time for us to take another short break, but coming up on the other side, we begin our coverage of the Auto Expo 2018. Up ahead, we tell you what to expect from India's biggest auto event this year. Stay tuned. Welcome back. You're still with us on Reporter's Diary. CNBC TV18 has done a special analysis of reports of the Food Safety and Standards Authority of India over the past few years. The analysis has revealed that food adulteration in India has almost doubled in the past 5 years. In the year 2017, 23% of the samples analyzed have been found to be unsafe. CNBC TV18's Priya Sheth is here with the numbers. Priya, what else has the data revealed?
Well, that's right. Data analyzed from FSSAI annual reports over the last couple of years has revealed that food adulteration rate in India, or the percentage of food tested by government which was found adulterated, has almost doubled over the last 5 years. Over 60,000 food samples were analyzed by public, state and central food safety labs in FY17. Now, out of which 23% of the samples were found to be unsafe. Now, compare this to a 13% adulteration rate found in FY12, and this, as you can see, is showing the gradual increase in the food adulteration rate over the last 5 years. Now, do remember that here we're talking about the food that has been both adulterated as well as substandard. Now, this has not gone unnoticed by the state and central food safety officers. The conviction rate derived from the number of civil as well as criminal cases launched has dramatically increased from 11% in FY12 to 52% in FY17. This indicates that stringent action is being taken by officials. Now, interestingly, the data also gives us a state-wise split as far as states are concerned on which states had the highest food adulteration. Now, significant states among those are Punjab, which had the highest food adulteration rate at 55% in FY17. This is, of course, followed by Uttar Pradesh, Kerala as well as Chhattisgarh. Now, even back in FY12, Chhattisgarh as well as Uttar Pradesh had the highest adulteration rates. Now, let's look at the states with the lowest food adulteration rates. Bihar, Meghalaya as well as Gujarat had the lowest food adulteration rates as far as FY17 is concerned. This clearly indicating that either the food quality in these states is genuinely good or there are some loopholes in the inspection and testing. Now, back in FY12, Karnataka as well as Gujarat had the lowest food adulteration rates, with increasing focus on quality, self-regulation as well as good manufacturing practices. It does remain to be seen how this shapes up going forward.
All right, Priya, thank you so much for bringing us those details. And shifting gears to some auto action of the day. Ahead of the Auto Expo, we spoke to the top management from Tata Motors and Mahindra Electric on what to expect from the Expo. Tata Motors' Gunter Buschek said that they are planning to launch 2 new vehicles at the Expo, while Mahindra Electric CEO Mahesh Babu said that more impetus on electric vehicles will lead to lower battery prices going ahead.
We are also going to show you two vehicles tomorrow, 2 show cars tomorrow, which will be officially unveiled, world premiere at tomorrow's Expo. The one is called H5X, the other one is called 45X. Both of these platforms, these are the 2 new platforms, we talked about it several times, are package protected for electrification. That's possibly already good news. So that means that in the moment we actually see a stronger movement and the famous alignment I have just been talking about towards electrification. With a reasonable effort, we can actually bring electrification to these vehicles.
We have been always saying that when the battery prices comes about $100 per kilowatt hour, the cell prices comes about $100, it will be very close to the economics of fossil fuel with the current fuel rates. So we see between 2022 and 25 would be the time period we are already seeing a visibility towards reaching this target. What we have been buying last 2 years back and now we are seeing a decline, and once the volume comes up, it's a volume game. So the more and more vehicles you produce, the battery guy is going to give you better rates because it's economics of manufacturing.
And we'll bring you all the action from the Auto Expo right here on CNBC TV18. But with that, it is a wrap on this edition of Reporter's Diary. Many thanks for watching. Stay tuned to CNBC TV18. Up next is Citizens Monetary Policy Committee.
Well, those are the headlines that we're tracking this evening. You're watching CNBC TV18. I'm Arif Sherwani, and this is Reporter's Diary. And at opening bell, Dalal Street plunged to its lowest level in 2 years. The signs were ominous, with markets sinking across Asia thanks to a sharp overnight fall on Wall Street. Just a few hours after opening, the Sensex was clocking losses of over 1,000 points. But with just a few hours left in the trading session, the bulls staged a recovery, with the Sensex gaining over 700 points from the day's lows. But nonetheless, it was the 6th straight session of losses for our markets. The Nifty is back below the 10,500 mark, with just 4 out of 50 index stocks ending in the green. Mid-caps also mirroring the fall in blue chips. At 1 point, 42 stocks were declining for every advancing stock. So that was the ratio, and that ratio improved by the end of trade to about 5 stocks declining for every advancing stock. Anuj Singhal is standing by to explain what was an extremely volatile day on Dalal Street. Anuj, a 6-hour roller coaster ride, it seems.
Big roller coaster ride. In fact, I'm a fan of roller coaster ride, but I think those in the market today may not have preferred something like this. Just take a look at what happened today. The Sensex opened at 33,753, immediately made a low of 33,482, but after that saw sharp intraday recovery. In fact, almost a 900 point intraday recovery is what we saw, 34,521. But once again, towards the end, there was some selling pressure, and we finally ended at 34,195. It was more pronounced in the Bank Nifty's intraday chart. If you take a look at that, opening at 25,140, immediately going to a low of 25,023, as you can see in that graph. After that, look at that sharp move at around 2. Once the Dow futures turned in the green, it went and made a high of 26,140. Before closing once again slightly lower at 25,811, as you can see on the screen. Now, amidst all this, Dow futures saw an intraday move of 600 points. So from being down about 400 points at one point, the Dow futures were up 200 points, and that sort of continued across the last hour. The problem is that the global markets have seen a bit of a risk off, and the catalyst this time is a reversal of a product called short volatility. Essentially, there was a product where you could just short the volatility, and because you saw a huge rally in the volatility index, it was more a case of the market leading indicator turning a bit of a lagging indicator, and that's what happened in today's trade. In terms of individual stocks, just take a look at how some of these stocks moved. HDFC Bank, HDFC, I think intradays would have been better, but both these stocks, after big declines, saw intraday recoveries as well. On the other hand, IT stocks, TCS, Infosys, they were dragging markets big time. And of course, Lupin, post the numbers as well, was down quite a bit in trade. But, the big recovery was reserved for a lot of non-index large caps and mid caps. Once again, intraday would have been better, but if you see the stocks like M&M Financials, Mindtree, Page Industries, Jubilant Foodworks, Canfin Homes, now they're showing gains of 1 to 3%, but all of these stocks started about 10% lower. So intraday, there was a big 10% rally. Short point here is that right now, the global markets are in a state of flux, and nobody knows what the next move is going to be in the global markets. And that's why perhaps maybe sitting on the sidelines could be the best strategy. That's what the experts tell us.
Right, Anuj, thanks so much for joining us with that absolute carnage of a day on the Dalal Street today. But Asian markets took cues from the sharp cuts on Wall Street last night, and they closed with deep losses as well. So Japanese Nikkei and Hong Kong's Hang Seng saw the sharpest cuts. China Shanghai Composite and the South Korean Kospi also got battered in trade. But let's go across to CNBC's Nancy Hungerford, who's wrapping up the day's market action from Asia.
Asian stocks firmly in the red for the second straight day after the Dow Jones's 1,000-point drop overnight. Take a look at some big milestones here in Asia. The Shanghai Composite lower by 3.4%. That is its worst performance in 2 years. This after bucking the global downturn just yesterday. The Hang Seng, meanwhile, finishing lower by about 5%, slightly over that level. That, too, would be its worst day in over 2 years. The Nikkei did ease off the lows of the session, at one point touching down more than 6%, still finishing off some 4.7%. That is its worst percentage drop since the U.S. election. Let's take a look at the volatility in the Nikkei as we track an uptick in volatility globally. No different in Japan. The Nikkei Volatility Index higher by almost 52%. Taking a look at some of the big stock movers, crypto-related stocks. They were on the move firmly to the downside, as you can see here, both in Japan and South Korea, all the way lower by up to 13%.
Right, so red across the screen, deep cuts on Asia. Let's also take a look at how European markets fared. So we'll bring up those charts for you, where key indices like the French CAC, the German DAX, as well as the British FTSE, all trading with deep losses. So there you have it on your screen right there. The British FTSE down 2%, the French CAC down 2.3%, the German DAX also close to 2% lower as we speak. Now, the big question is, what will this global market rout, which was triggered by sharp declines on Wall Street last evening, will it haunt U.S. equities today as well? So the U.S. stock futures, which were earlier indicating a positive open, are in the red as of now. So the Dow Jones futures down, indicating that U.S. equities might open lower. But with a few more hours to go for Wall Street opening, that situation could change. So it has been a volatile day as far as the futures is concerned. Let's see how Wall Street opens. But moving on from there, JSW Energy is betting big on electric vehicles, and we can see the first product launch in 3 to 4 years. That's the word coming in from Prashant Jain, who's the joint MD and CEO at JSW Energy. He told Yash Jain that the company is looking for partnerships with original equipment manufacturers. Listen in.
We have been continuously working on the product strategy as well as the capacity building, and there are the concrete steps which we have taken up in that regard, and we are evaluating on all options, whether it is the partnership with the OEMs or working with the engineering service providers, and so we will let you know at right point of time. As regards to investment, as we said in the past, that we are talking about close to 4,000 crore rupees in capital investment, and which may go up depending upon the product portfolio and our product strategy over a period of time.
You mentioned that you let us know at the right time. What could be this right time? If you could give us some understanding in terms of when would we be able to hear about the first set of prototypes, let's say, coming from the electric vehicles venture?
Yeah, so we are in process of that, but you can reasonably expect that our product launch will be between 3 to 4 years from now.
Right, so a new field for JSW Energy. But on that note, we'll slip into a short break. Coming up on the other side, we get you an interaction with the NSE chief, Vikram Limai. His first interview after the Singapore Stock Exchange started trading 50 India stock futures. Don't go anywhere.